Peter deBaptiste, welcome to Acquiring Minds.
Thanks for having me, Will. Excited to be here.
Peter, you bought a plumbing business in South Florida, your home. Let's start off with some background on you, Peter. What was the path that led to you buying a plumbing business?
So I'm happy to get into that and excited to be here. This podcast really helped me in my search. So I used to
Awesome,
I used to run a lot, and I would listen to back-to-back episodes when it first came out. So avid listener.
Fantastic.
Excited to be here.
Cool. Really cool.
All right. Background.
Yeah.
So I grew up in South Florida, born and raised down here, lived some other places over the years. Started my career in banking as a lower middle market lender. So I was making loans from 1 to 15 million to, mostly family owned businesses down here. Not SBA, but kind of similar size type stuff, to the search world. And, after that, I, worked for a company called Delivery Dudes for 7 years. We were kind of a high end Uber Eats, South Florida based. And I started on the finance side of that business, ended up as president, kind of running the corporate team. So we grew the business from, probably 20 something employees to 125, had 1,000 driver contractors, like Uber drivers or independent contractors. Learned a lot of lessons. We implemented EOS. We, had a ton of challenges growing that business and, fighting off competition with 1,000 times our budget. Ultimately, we cleaned the business up. We made it profitable. We really transitioned from a high growth, cash burning business to a kind of more stable, profitable business. And we exited in 2021 to a small publicly traded competitor. And after that, kind of began my search.
Great. And when you said you duked it out with competitors that had 1,000 times the budget, we're talking Uber and I guess Lyft. Does Lyft even do delivery? Is Lyft even around? I was never a Lyft user. Of course they are.
They're around, but
My wife uses it.
Yeah, I don't think they got into the food delivery space. So we were up at Uber, DoorDash, Grubhub.
Of course. Yeah.
Yeah.
Guys,
so a lot of dollars. We were kind of the smaller, we were all South Florida, kind of the small guys. We were early entrants to the market, but never raised enough capital and, did great in the beginning. And then when the big wave of competitors came in, really had to fight them off. And the growth, that was once free or cheap, kind of fell away. So, we found ourselves in a position of, burning millions of dollars a year with not a lot in the bank and basically transitioned that from, losing money to making money. We had a pseudo franchise business, not a pseudo franchise business. We had a franchise business that was from the early days of the business and really held us back from exiting. So we had to ultimately go and acquire back a bunch of these franchise markets. So kind of got a taste of, transaction stuff from that. We rolled in all these old franchises, kind of packaged up the business. So it was finally in a place to, to be sellable. And we exited the numbers public. It was 23 million. So it was a nice exit. My outcome wasn't life-changing. It was more of a, transaction bonus size outcome, but allowed me to, pursue the self-funded search journey.
Thank you for that additional color. Good for you guys for staring down Uber and, like you said, Grubhub and DoorDash. Those are some fearsome competitors. I mean, I feel like there's no better example of huge quantities of venture capital leading to bloodbath than in the restaurant delivery space.
Yeah. It was a wild ride. So we were definitely the little guys. We were the inexperienced guys. We had a young team and we kind of slogged our way through it and came out okay at the other end.
Really, really cool. Okay. Well, you have this exit and you and the team exit, having kind of survived this tribulation with these really fearsome competitors. What you do next, it could have been any number of things, Peter. So searching for a small business to buy was not obvious. Connect the dots for us.
So I, probably a year before we exited, I had a close friend who's on the podcast shortly before me here, Morgan, and he moved back from California with his soon-to-be wife, and was kind of settling down here. And he introduced me to this whole concept of search fund. He was interested in a traditional search and had kind of gotten a few months of networking and exploring ahead of me. And he introduced me to this concept, and I kind of said, man, that sounds awesome. That sounds like a perfect fit for my background with some lending experience. Neither of us were kind of traditional MBA type searchers, but I had the lending background. I had some operating experience, and I had a pretty good network down here. And so he and I ended up kind of pursuing a partnered search. This was probably 2020, and we started exploring a partnered search, and we were kind of getting along the ways. I have a feeling we would have ended up doing self-funded anyway, because we were both kind of geographically focused down here. So I don't know if we ever would have executed on that partnered search, but right around that time, as we were getting more serious, COVID came around. COVID obviously had a huge impact on the food delivery space. So delivery dudes all of a sudden went from a very challenging journey where the exit prospects were limited. We had a failed exit or a failed exit effort a couple years before, and all of a sudden we said, well, this business is picking up. This is our opportunity. And so I met with him and I said, listen, I gotta stick with this, see this through. So I basically spent another year at Delivery Dudes, tidying everything up, running the exit process. He went and searched. He acquired a home healthcare business down here, and I got to tag along and learn about his process and see it from the outside. And all the while I kind of knew that was my next chapter. So once we sold the business, I think that was, March of 21, something like that. I was working for the company that acquired us for 6 months, and, kind of doing a little networking, drumming up a little bit of deal flow, knowing that, hey, at some point I'm going to break away and search. I didn't know if it was coming soon or not. And thankfully I had that head start because the company that bought us fired all the founders after 6 months. And there was my kick in the rear to go start searching.
And just so we understand, so Morgan McCauley is the friend, and he will have aired a few weeks prior to when people are listening to this. And Morgan introduces you to the concept of search, and you I'm always curious, even though it's almost always the same answer. I'm always curious to ask what attracts people to it. What did you like so much about it? Especially given that you were in a 0 to 1 startup. You hadn't been one of the founders, but you were there. You got to see a pure 0 to 1 startup up close, and that it could be successful. So if anything, I would imagine your takeaway from that experience was mostly positive about working in pure startups. So anyway, how do you respond?
I think for me, it's a little bit of personality fit. I was in that business. I was the president next to what I would call like the visionary CEO. So I was always more of the execution guy. I was the day-to-day. So I never felt like I was going to come up with some brilliant idea or go build a software business from scratch. I was attracted to the idea of taking over something existing. I liked boring businesses. That was my whole banking career. So it was attractive from, I think skipping the 0 to 1 part was attractive. Mm-hmm. The financial opportunity is attractive. The post-search opportunities to do it again, or become an investor, or what, you kind of have your options open to you. So I think it's just I don't know. It felt like the right thing to do.
Say more about the fact that you liked, quote, boring businesses. given your exposure to them as a lender into the SMB ecosystem. And maybe tell us a little bit more about that. You said it wasn't SBA, but it was similar, although not for acquisition, more for, I guess, growth equity or CapEx. Just talk to us about that experience and how it formed your attraction to boring businesses.
Yeah, so I was a lower middle market lender for a bank called Comerica. They're a big bank, but they're not necessarily a household name. And we focused on mostly family-owned businesses. We did some, kind of private equity-backed leverage buyout type deals, but I would say the bulk of our client list was kind of established, boring mom and pops. A lot of them were on second, third generation. A lot of manufacturers, distribution companies, not really search type companies. They were companies that needed capital, right? So by definition, they don't make enough money to pay off their debt, and they are in perpetual need of borrowing money from a bank if they're a banking client. So kind of lousy search candidates. But I always found the coolest part was just seeing the inner workings of all these funky businesses. I had like a drill bit manufacturer. I had a frozen shrimp importer. I had the guy who sold in Walgreens around the holidays where they would sell DVDs for like $3.99 each. Like I had that guy as a client, right? So there's just like all these cool businesses, and I was always it was just so interesting. Like there's all these different ways to make money. I felt that most of these operators were, kind of like my peers, if you will. Like they were people in the community that didn't, it wasn't like you're meeting Jeff Bezos or something, right? It's just like the guy who sells DVDs in Walgreens, and the guy makes a boatload of money and has a good lifestyle. And I always just found it just seemed approachable. And the seeing businesses transition or fail to transition from generation to generation, I just kind of had this gut feel. And it wasn't like I had this grand vision from, when I was fresh out of college working for the bank for 4 years. But I just noticed that like a lot of businesses, the second generation wasn't there or wasn't interested or whatever. And the general theme was that these aging owners had not really great exit paths. And it just kind of sat with me as something that kind of stuck in the back of my head as an opportunity. I just didn't know. I didn't really understand what it meant. Yeah. Or what the opportunity was.
Yes. So that a lot of elements of that are not search, but a lot are. I mean, that kind of falling in love with all of the weird and wonderful corners of the economy where these businesses hide and thrive is definitely a feature of search. And the other stuff you said, the lack of succession and the approachability of it all. So you were really primed. You were really primed to fall in love with search when Morgan brought it to you. And just for our kind of general business edification, something that you said that I feel like I can learn from about, you were lending into businesses, manufacturers, distribution companies that needed loans to keep going. Can you just say more about that so we can learn what that means?
Yeah. So when I started searching, I pulled out my old files and I started going, oh, well, what about all these businesses that I know? Are these good acquisition opportunities? And I pulled out all my old loan files, which I probably shouldn't have, but I started looking around, and what I realized was, just by simple virtue of the fact that these businesses were customers of the bank for 20 years, they were kind of not great businesses. These manufacturers and distributors, some of them are good businesses, some of them make money, but a lot of them were like, they were sitting on a $5 million line of credit that they were never able to pay off, and they made a couple $100,000 a year after paying off all this stuff and just never paid off the debt. And so we had plenty of businesses that really, printed money and did well, but for the most part, when I looked back at, maybe I should go after some of these guys I know, from the old banking days, I realized they were asset heavy, slim margin, and carried a lot of debt. So it was just kind of like not really your search target stuff. Manufacturing distribution as a general thing, right? You have in manufacturing, you have a ton of equipment, and in distribution, you have a ton of inventory, a ton of AR, and slim margins, right? So just by nature of that, kind of like a couple of things that you don't like in search.
Yeah. And this concept of them carrying debt. So what they would do is they would just refinance the debt when it came due, kind of a perpetual refinancing cycle. I mean, if you're carrying a huge debt, doesn't it eventually gobble you up? Or no, can you just kind of refinance in perpetuity as long as you're making interest payments?
Well, there's two major kinds of debt, right? There's a term loan that you pay off, which is, kind of like your acquisition loan that we're familiar with. And then there's like a working capital line of credit. So
yeah,
a lot of these businesses had, working capital lines of credit. And then there's nothing wrong with it, but you can have that in perpetuity. It's backed by collateral. It's used to finance your AR and inventory as you're waiting to get paid by customers. But that can sit there forever. And a lot of them had, had other loans that would just kind of refi, or they would buy something new and they would need money for it. So yeah.
Gotcha. Great. Thank you for that, Peter. That's great. This is great prep. So delivery dudes, exits. You have been watching Morgan for last year go through his search journey. You now have the time to turn your own sights on it. What does your search look like?
So my search was probably, I think everybody got fired in September 21. It was like 3 days before the birth of my child, which was just a real nice thing. And so I had kind of, like I said, I had a little bit of deal flow. I had kind of done some networking, but basically, had my kid and kind of continued continued keeping that spin going. Once you get the deal flow going, you've really got to just put in a certain amount of effort every day and every week to keep it going. So, didn't really take any breaks. I wasn't like cold call searching, right? So I didn't need to work crazy hours, but, I had my kid and just did your kind of traditional self-funded search. I started off with a pretty big range. I kind of said I'm looking for, 2 to 20 million of enterprise value and, industry agnostic as long as it's in South Florida or can be run from South Florida. So I kind of set a wide range of size, and I set a wide range of industry. I started looking at some e-commerce businesses, some stuff that, was a little bit less search typical stuff. And ultimately kind of after the first few months, kind of wound my way back into traditional self-funded land, which is more of like the, 2 to 7 million of enterprise value and, industry, a lot of trade businesses, a lot of, I don't know. So kind of talked myself out of e-commerce in short and software businesses and stuff like that. Ended up back in traditional self-funded search land. The economics, when you go larger, just seemed to kind of not be as attractive. It kind of felt like the outcome is maximized when you have like a business that maxes out the SBA loan is when your peak economics are. And then if you buy bigger and bigger and bigger, your economics don't really go up as much. So I kind of crossed off the higher end of my range, crossed off some of the industries, and really started getting a little bit narrower into what I would call like guys and trucks businesses. Were kind of like my sweet spot target.
Peter, let me stop you there because I have a couple important follow-ups. This is great. First of all, so your initial range was broad, 2 to 20 industry, looking at a lot of different industries. But that 20 number jumps out at me. $20 million of enterprise value. You were even contemplating that. So I guess and so as listeners will know, the SBA loan maxes out at 5 million. And as you just put it, like, so typical range for a self-funded searcher is going to be 2 to 7 million in enterprise value. You were open to buying something 3 times that size. That's that's pretty big for us. And so obviously you would have raised equity, a considerable amount of equity. How would you pull that off? How did you even envision pulling that off, even though you didn't go that path? Just like how does somebody who's doing this for the first time even contemplate that?
Well, there is a it's not quite as well trodden as the SBA path, but there's a very well trodden path of acquiring businesses in that size. It's a little bit of a valley where there's less capital opportunity than the smaller or the bigger size of that. But there's plenty of people who lend in that space, right? So like, when we did leverage buyouts at the bank, like we were in that zone. So I just, I did a little bit of networking through the search community and just kind of had enough. I felt like I had enough network where if I found a good deal that was 20 million, I would have been able to pull it off. The financing looks different. You got to raise, either traditional bank debt, with like a mezz debt, or you find like there's some funds that do blended with everything. And then, you're probably on a little bit more institutional size check for equity. So that basically the nature of putting together a deal like that, what I saw was that it shrank your ownership, shrank your control, and didn't seem like it was much better of an outcome.
Well, that was the other profound thing I wanted you to elaborate on. So please do. I mean, and let me just frame it again for the audience. I mean, I haven't stress tested this or modeled this myself, but what you said a few minutes ago, that looking at it purely kind of for the financial outcome for the searcher, that, looking as a self-funded searcher, $2 to $7 million enterprise value using an SBA loan has, if you go up and you find a bigger business to take down, the terms will change, the equity, the whole cap table will change. You'll have less equity, certainly. And the final outcome, but when the story is over and you've, let's say, exited the business, the final outcome to you is not necessarily that much more compelling, if at all, than just buying the smaller business to begin with. I think that's a really important insight, because I think we just assume that the bigger the business you buy, the more likely you'll have a bigger outcome, you searcher. So I just wanted to double click on that, and you were about to readdress it. So please do. What more can you say to it?
Well, so that was kind of what I had learned by talking to people, what I had learned and seen in my banking days, and what I had been able to model. You've had, I think, what's the guy? Is it Robert Graham that does SIG?
Yeah.
The guy who's like the absolute self-funded search.
Yeah.
He's holding the torch and charging ahead, trying to make self-funded search the dominant form of search, which I love. But he's had a lot of stories of outcomes where searchers are acquiring $20 million deals and owning 80% of the business. I'm sure those outcomes are possible. I just found that the deal quantity, one, was really slim. I was geographic focused, South Florida. So, very slim population of deals of that size. The multiples and the process was really competitive. So, it's a harder thing, right? It's the smaller, a lot of guys go for ultra small deals and they'll say, oh, just go buy something that does like 300,000 of SDE, get in the game, and you can have really high confidence that you'll be able to succeed, or that you'll be able to survive, because you're paying a tiny multiple and you're in the day to day, and you can have confidence that you're not going to screw it up. Versus if you're buying something that's like a $20 million business, you're paying a high multiple, you're leveraged to the gills, you got bank covenants, you got, multiple institutional equity and debt partners that are going to be breathing down your neck if you screw something up. And you've got a management challenge that, I felt like I was, had a little bit of experience that I could handle something of that scale. But I think the management challenges, are real. If you don't have a management background, you try to go buy a business with, 50, 100 employees in it. It's a different beast. And when you're starting at a high multiple, you have to grow in order to hit your outcomes. Versus if you buy something a little bit smaller, all you have to do is maintain.
Yeah. Yeah. Another fantastic point. You kind of narrow your aperture after a while, let go of entertaining e-com, let go of being open to a really big deal like the 20 million we're talking about. And it kind of narrows to, I think you said 2 to 7 million. Pick us up from there.
So from there, I got under LOI on a mulch blowing business.
Mulch blowing.
Mulch blowing.
How is that? How is that?
For any
just
searchers
blowing
that
mulch
are
around
listening,
a service?
If anyone's looking for like a really good niche roll up play, or even just, I don't even know if you need to roll it up, but it's not a business that was going to, be a huge business, but man, it was a good business. I'm glad I didn't close it. Learned some stuff about the seller close to the finish line that I didn't really love. Just some character issues got exposed. But anyway, I was under LOI in this mulch blowing business for 3 months, took it almost to the finish line, had all the dead deal costs that you can imagine. And, the guy just went ghost at the end. We had a couple bumps in the road. And I think honestly what happened is he had a lot of debt on the business. He had large bonuses promised to his employees at exit. He had the broker fees, and he was going to have to pay taxes. And he had to recoup, he had to pay taxes on all his assets that he had already written off. So I think he did the homework at the end and said, wait a minute, why would I sell for whatever if I'm making this much a year? By the time I pay off my taxes, my debt, my broker, my employee bonuses, he was going to earn what he makes in a year and a half, maybe. Yeah. So I think that's what happened. But there was some other stuff along the way. We don't really need to get into that side of it. But the business was, it's a really interesting business. I would encourage searchers to, if you live in a community where there is that stuff, like Florida, California's got plenty. I talked to some mulch blowing companies in California for diligence. It's a cool business. So you basically have these large trucks. They're like the size of garbage trucks. They're expensive. I think they're like $300,000-$400,000. And you load up this truck filled with mulch, and then you have like a 4-inch hose coming off the back of it, and you blast in mulch at HOAs, at golf courses, for playgrounds at schools. And this business had a lot of contractual revenue. So municipalities have all these playgrounds, all these parks and properties to maintain. So they have to blow in mulch every year. Schools do as well. And so you have a lot of recurring revenue, a lot of contractual revenue, and a little bit of barrier to entry, right? It's hard for a little guy to buy a $400,000 truck. And it's like, it's a small line item for everybody. So if you're running a school, when are you going to analyze the cost of your playground mulch? Never. So it was just it was a cool business for those reasons.
Yeah, that sounds great. And Peter, when I think of mulch, not having a green thumb, barely ever even pushing a lawnmower in my life, I'm not proud to say, but I think of spreading mulch. That's the verb I usually attach to mulch, not blowing mulch. So I guess when you have much more square footage you need to cover, the volume needs to be bigger. You got to use a truck. You don't just have the landscaper spread mulch over the playground.
Yeah, exactly. So picture a playground's a good example, but a country club's probably a better example. Think about how much mulch is around a country club. And if you're going to go and unpack bags of mulch and have, a team of guys out there with wheelbarrows and rakes, if you do it with one of these big trucks, it just has this hose that's blowing out,
Yeah.
air powered mulch, and you just spray it. And, so there's a higher equipment cost, but the install cost is much lower. So
Cool.
It was a cool business. There were like 3 companies doing it in all of South Florida, and all 3 of the guys were like 68 years old. And so I was just, it was a cool one. Not
Mulch blowing, everybody.
Yeah, mulch blowing. Get into it. You're welcome for the idea.
Okay, so that one doesn't work out at the last minute. In retrospect, you're glad it didn't. Then what?
Yep. So that one doesn't work out. I always like when people give like real data points here. So I took that one almost to the finish line. We were probably, I don't know, we were like about to sign the APA and probably would have closed 2 weeks after that. My dead deal costs were probably $35,000. So for anyone who's looking for a reference point,
Yeah, that's
take
great.
a deal close to the finish line. That's I think that's in a normal range of where you end up.
That's real pain.
Yeah, so that hurt.
So you're 35,000 in.
35,000 in.
And by the way, so are you feeling discouraged? What's your headspace like? $35,000 poorer.
Yeah, it's not great. First kid, we had moved into an expensive house, a year before, and down to wife's on maternity leave, which is only partially paid, and so the line is pointed down, right? The airplane is flying in the sky, and there are trees at the bottom, and you're flying down towards the trees. So you really, there's an end in sight, and you just made it a lot sooner, by erasing that 35 grand. So that was a tough one, but no, I knew it was a possibility. I knew it was more than a possibility. I knew it was likely. But I think the more likely outcome is you kill them early in diligence when your deal costs are like 5, 10, 15 grand. Not so close to the end. So that hurt.
Well, and just to say another little tip to the audience there, which is maybe obvious, but also push out once you got a deal you're working on, push out as long as you can spending money in assembling that deal team. There's kind of a sweet spot because obviously a lot of stuff on the deal you're going to need third-party service providers to do for you, but kind of go as long as you can without starting to spend that money. And then if the deal looks bad, cut it as soon as you can so that you're not continuing to spend money. So
Yep, exactly. And I did all the right things on that too. I did exactly what you described, but it just died at the end.
Yeah. Thank you for sharing the number. Carry on.
All right. So mulch blowing deal died. I was still in the market, but I wasn't, full bore searching. Everybody says you got to keep your deal flow alive. You got to keep your deal flow alive. But, you say that after spending 75 days of working on getting a deal across the finish line, you start to see the end, and you just, your first 2 weeks under LOI, you're still drumming up deal flow. But the closer and closer you get, you're like, this one seems pretty likely.
Sure.
So the deal flow slowed down a little bit, but picks back up. There's kind of probably like a 2 week or a month lag from when you start to pick it back up to when you really get stuff going. Looked at a bunch of other stuff and ended up on a call with a broker with a fencing company. And, he was kind of playing the quarterback and pushing me away. And then I think I impressed him on the call. And afterwards he goes, "Oh, well, I got this plumbing business coming up, but you're really not going to be a fit for it. For X, Y, and Z reasons. You don't have your license and blah, blah, blah." And I said, "Come on, let me take a look." So got to take a look, took the seller out to dinner, after a phone call or two, after we had our kind of management call, took the guy out to dinner, hit it off. And just to kind of tie it back to like the whole searcher pitch, like what I said to him is what I said to a lot of people is, it's like, listen, like the reason I want to do this is because I want the lifestyle that you had for your family. Like, I took this guy out to dinner. He's talking about how he sent his kids to a good school and, got to take his boat to the Bahamas, which is a Florida thing. And I was like, listen, like that's my goal. Like, I'm looking for a business that will allow me to send my kids to a good school and teach them how to go fishing in the Bahamas. And that, I think, is, maybe that was, the piece that you're not hearing from the Stanford MBA who's moving out to Akron, Ohio to go buy Bob's HVAC shop. But that was real. And for that reason, I think the seller really liked me. So I made an offer. I was, I think I was tied for highest. So I didn't, it's not like I got him to take 10% less money for me, but I also had some structure on it, which we can talk about. So I think I got away with some extra structure, if you will, because I was me. I didn't find out till after closing. My first day with him, he pulled up his Outlook. He goes, "You see all these folders on my inbox?" I go, "Yeah." And he pulls up, there's like 22 folders. He goes, "Every one of these people made me an offer."
Wow.
So that, that was
Good
a
for
cool
you,
thing
Peter.
to learn. It was it was a competitive deal. I didn't even hear about how competitive it was. But I think a lot of them were like a lot of them were the people who looked at the sim and fired off an IOI. And he basically said, "Listen, you're the only one who took me to dinner. You're the only one who wasn't going to fire all my employees. You're the only one who I felt like would keep my kids working in the business, and we had the relationship." So it's a big thing. The whole pitch that comes with search, I think, is real. You got to be able to connect with the seller.
Yeah.
And that happened.
And Peter, just the thing that you said to him about what your vision was for the lifestyle that buying his business could afford you. What do you think resonated? Why did that resonate so much with him, as opposed to, you, as you said, like a fancy MBA coming in and saying something different?
I don't know. I think nobody wants to sell to a guy that they don't know, right? If you think about somebody who's from your community, who shares your hobbies, who, it's somebody who's in your network, like
Relatability.
yeah. I don't know if we knew the same people or not, but like, yeah, it's somebody in your network who you can trust because they're in your community. And I think that's just a big piece of it, right? The other people were, private equity backed roll-ups from out of state, or I think there were a couple local companies, but they were all going to basically press delete on his office. And, and so that, that message played out, and
it's kind of, it's the trust of somebody who's local in the community. So there's kind of a trust element there, or an implied trust element there, and also a continuity element. He saw in you a guy who's going to carry his business forward because this guy, Peter, has said to him that, like, what you have, sir, is what I want.
Yeah, exactly. And that was part of the diligence process, always looking at a business. It was always a really quick yes or no for me to just figure out what kind of life does the seller live. Like, does the guy live in a nice house? Like, does the guy have a cool boat? Does the guy have a bunch of debt? And I looked at some businesses that were on paper, like making all this money, and you look up the owner, and the owner's got like, tiny net worth. He's got like a car loan, a boat loan, a mortgage. And, I'm like, how's this guy making, whatever in earnings and doesn't have anything? So anyway, that was like a nice little diligence piece, is that this guy had, kids went to private school, paid the kids college, had a, Midnight Express boat, had a second condo in the, in North Carolina, just, so you get some of those data points and you go, okay, whatever the numbers are, there's something here. And there's a lot of deals where the numbers show one thing and the seller's, not really doing so hot.
I love that, Peter. I mean, I've had a guest or two say that, but it's not something that comes up often at all. And it is such a good kind of proxy to examine, because fundamentally the lifestyle of the seller, owner, founder is kind of the final indicator of how healthy this business is. And, kind of stripping away all the financials and whatever the numbers say and the tax returns and kind of that morass that we all try to untangle, like net it all out. What kind of lifestyle has this founder been able to afford him or herself with this business? So it's a great kind of qualitative assessment, I think. So thank you for mentioning. So tell us, so the name of the business is?
Joe Cole Plumbing.
And it's Joe himself that you're taking to dinner?
Yes. Yep. So
Joe
is
Cole.
the founder. Joe had another partner. So there were two sellers, which we'll talk about in a minute. Adds a little layer of complexity when doing the transition, when you have two sellers to replace versus one. But yeah, so it was Joe. He had his two sons in the business. They're still there. They still do great. So they're kind of the leadership team now with me. And I think that was a big selling point for him was they're a little bit younger than me, not too far behind, but I think experience wise and maybe, capital wise, he kind of said, hey, this guy's they're going to be in a learning environment with this guy. So I think he looked and said, hey, he wants them to stick around in the business. I'm talking about me being he. So Peter wants my kids to stick around in the business. They're going to learn a lot from Peter, and it's the best way to move this thing forward. And it's a common thing. I would say it was at least 50% of the businesses I looked at had a kid in the business, and it was always a question like, why isn't your kid buying this?
Yep.
So they had to have a convincing answer. But yeah, that was the business.
And can you give us some more data points on the business itself, numbers?
Yep. So business was, right now we have 35 employees. I think we're a little bit less than that at closing. We are I would call kind of a higher end plumbing contractor. So size range, just, in terms of self-funded search, I will say self-funded search typically focuses on 500,000 to 1.5 million of EBITDA. And we are in that range. So you got that, you got the employee count and business model. Basically, we're a high-end plumbing shop. We do a bunch of different stuff, but probably our two biggest lines of business are we do ultra high-end residential construction. So Miami Beach custom homes on the water, 10 million and up. We do the construction for those. So that starts with, underground piping up the walls and installing the high-end fixtures and crazy showers and stuff years later. So kind of large long-term projects. And then we also do a ton of commercial service for national retailers and grocery stores. So the business was, had a construction component, which most buyers dislike. I think that chased off some of the buyers, and I think it kind of pushed down the multiple into, self-funded search range. I was able to get comfortable with it, although like right before closing was when the headlines were I closed June of 22, and literally like May 15th, 2022 was like the beginning of a 3-week roll right before I closed, and every headline was interest rates are going through the roof, construction's going to dry up, we're about to enter a recession. So I had a real soul search to do. But yeah, so the business does service and construction, and
it does service as well.
Yep. Yeah, so we're about 50-50. And our service, like I said, is a little bit more, we do residential, but it's a little bit more commercial focused. So customers like Whole Foods, Marshalls, Lululemon, kind of national retailers and grocery stores is kind of our bread and butter on the service side. And then we also do, we do plenty of other stuff as well. We do residential service, we do commercial construction, we do all the categories.
No. Okay. And is that common for a plumbing business to do all the categories? And by all the categories, you basically can think about it in terms of, as you said, construction versus service. That's the one we often think about. But then also residential versus commercial. So there's kind of 4 categories there: residential service, residential construction, commercial service, commercial construction. Is it common for a plumbing shop to do all 4, or is it typically focused in 1 or 2 of those buckets?
I've noticed, I think it's more common to do, 2 of the buckets rather than 4. The business was definitely, I would call it's diversified, right? And it's a good thing in that revenue's stable. You don't have to worry as much about residential construction drying up because, no line of business is 90% of our business. Like I think that, the residential construction's like 30 something or 35% of the business, right? So like if we enter a recession and residential construction dries up, one, we're in this like ultra high end billionaire clientele, so it's kind of a little recession resistant. But 2, even if that falls off, you're still only, affecting a quarter of the business or a third of the business, right? So that's a good side to it. The downside to it is, in order to make things scalable and fix processes and make things a little bit more organized, you work on a project to make something more streamlined or make a part of the business better. You're not really impacting all the business. You're only impacting a little piece of it. And each one of these 4 categories has some different elements to it. So like kind of pros and cons, I would say.
4 mini businesses under one roof.
Yeah. So pros and cons to it. I think like kind of what I would call like the poster child acquisition target for a lot of folks is a residential service only plumbing business or an HVAC business or an electrical business. That's kind of what, the target looks like, is all service, and residential is a little bit more favored than commercial for the most part. But, again, every deal is going to have some good and some bad in terms of your acquisition criteria. And so I just, I looked at this and said, listen, it's got construction. Can I get comfortable with it? Can I get a bank comfortable with it? I was able to do that. And, I think it brought it into, I think without the construction component, it wouldn't have been in self-funded search zone. There would have been some, some strategic buyer who was going to pay a crazy multiple for it.
Mm-hmm. Well, so 2 things there. First, on your point about diversification and how the kind of poster child of the plumbing or HVAC or electrical businesses is going to be a consumer focused or a home services business, and how those have been really hot and really appealing for the last couple of years. But I have a couple of interviews coming up with people in those very categories, home services, plumbing, and it's having a really hard time all of a sudden. I mean, it was the hottest thing for the last few years, and now it's getting really, really tight. And they don't, if they're only in residential and only in residential service, it's actually, they're not able to kind of diversify away this challenging moment. They're just meeting it head on. So this is kind of like your kind of thesis, if you will, is playing out in real time here. And then the other point you made about the multiple, like if it had been all home services, which has been so hot and appealing, it probably would have commanded a much higher multiple. Can you share what the multiple was that you are the range of multiples that you got your business for was?
Yeah, so I'll do the range again, but most of the deals in this category or in our kind of self-funded zone trade for 3 to 5x. I was in that range.
Mm-hmm.
And I think that if you're looking at, a larger, more established, like a plumbing company with 35 employees, that was 100% service, you're definitely going over 5x, or at least you were in 2021 or 22, right. Whenever. I don't have my dates
22.
Right.
Yeah.
So, definitely was, I looked at an HVAC deal of similar size, but they were 100% service. It was represented by an investment bank rather than a broker. And I called the guy And I was like, oh, explain my whole search story. And he was like, listen, he's like, I'm expecting to get 8 or 9x for this. Are you going to play in that
Wow.
range? And I said, no. So,
Wow.
so
There you
there's
go.
definitely, if you're looking in that space, I think a lot of people are, you're looking for you're looking for something with a little bit of hair. You're not going to find something that's got, you know, a million EBITDA already on Service Titan with a management team established and 100% service and all these processes in place. You're just not going to find it. You're either going to find something with some hair on it, or you're going to find something like I did with a construction component, or you're going to buy smaller. Or you get lucky and you find the diamond in the rough where, Bob and Sue really like you and don't put their business out to market. But I think, it's that home services space is a super competitive. I found that, it was, if you went into the really hot category that checked all the boxes, it priced you out as a searcher. And again, you could put together a deal and buy something at a premium multiple, but again, then you're forced to grow in order to justify that multiple, and it just makes life a little bit harder, I think.
What can you tell us about the structure of your deal to buy this? We keep talking about what larger deals could look like versus our end. So what did this particular deal look like?
So I did a fairly common structure, but I did take advantage of the full standby seller note thing where you can reduce your equity check. So I basically, I was 85% SBA loan, 5% seller note that was being paid over time, and then a 5% seller note that was on full standby for the life of the loan. So no payments, just accruing interest for 10 years. That gets counted as SBA, or it gets counted as equity by the SBA. And then the remaining 5, or a little bit more than 5%, was equity. So bought the business with, I think it was like 6% equity. I was networked and kind of had a group warmed up to raise equity. But because I was able to get this full standby seller note, I only needed a little bit. I was able to raise it from my dad. But, went to him by choice, not because I had to. He spent his career in real estate, institutional grade, multifamily real estate brokerage. He knows every property management company in South Florida, right? So for buying a business that does commercial service, great person to have on the team. Mm-hmm. I gave him basically your standard self-funded search equity terms, which you can hear about from other people and see on Search Funder, but probably gave him more generous terms than I would have had to give another investor. But so that was the structure.
Usually when we use friends and family money, Peter, we give them less generous terms than we would give to a professional investor. Great. Now, so 5% equity essentially, and bringing in capital from your father for the reasons you just described. But this means that you're going to retain a huge piece of the business. So should I read into that? Was that kind of a philosophy that you had, or it just worked out that way?
No, that was, that was really a primary goal. Was I wanted to maintain as much ownership as I could. I wanted to maintain as much control as I could. In hindsight, I don't wish I did it differently, but that came with, its own set of challenges. When you do use a lot of leverage, that means, talking about the airplane flying towards the trees, the tree line is pretty high. You got to cover those debt payments. So your ability to withstand shock and the J curve is tighter. And 2, the ability to invest in low-hanging fruit that costs you money now but might benefit you later is also a little bit restricted. So, I solved for the goal of owning the maximum percent I could. And, I think that like I wouldn't do it differently. I think I'm fine. I'm happy. I'm good with it. But I think it was something that I didn't really think about. One, how nice it would be to chase after low-hanging fruit and have a little bit of a budget to do it. You come into these businesses and there's opportunity. There's a ton of challenges. There's a ton of opportunity. And when you can't throw money at it because you got to just be, you want to feel really comfortable in your first, I'm 18 months in or 19 months in, you can't throw money at stuff. You can't make a hire that you want to. It's a little bit restrictive. And then the other thing when it comes to, leverage that I didn't really think through is the personal side. I wanted to maximize my ownership. So I said, I can live off a minimum salary. My wife works, and I said, we can, live off a little bit of, kind of a modeled a salary that was based on my current lifestyle, not really thinking that, over the next couple of years of owning the business, here comes 2 kids and the expenses related to that. And then you got a new car, and then you got, kids go to school, and you got a nanny that you didn't have before. So all of a sudden, my salary that I modeled from my pre-kid lifestyle was like, that was a little bit light. So anyway, I'm like, it's all good. Like, I don't have any issues. Thankfully nothing bad happened, and there was plenty of cushion. But I just found that I think I'm in a common spot for lifestyle where a lot of searchers are, kind of with young kids and all that stuff. So definitely, would share some advice of, one, be open to not maximizing leverage and maximizing ownership. Nothing wrong with raising money from outside people. It kind of would be nice sometimes to have, if I had raised money from somebody who had other investments in the space or who had some industry knowledge, that'd be nice to have kind of on your team. And 2, the whole concept of lifestyle creep, whether it's not really lifestyle creep, it's kid creep. When you're chasing after maximum ownership, you gotta keep those other things in mind. So anyway, I'm sharing it as a cautionary tale. Not that anything bad happened to me, but my cushion in terms of how deep the J curve could go was, I thought I had room for EBITDA to fall by whatever, 30% or something. But then when you factored in, hey, my lifestyle got more expensive, I need to raise my salary, and the J curve has stuff that's out of your control, and then the J curve has stuff that's deliberate. You're making decisions that cost money now that make you money in the future. So anyway, it just kind of I would advise thinking about that holistically. Having a little bit lower debt, could allow you to execute a little bit faster, a little bit, smarter on stuff.
Yeah. No, that was so important, Peter. Thank you for walking us through that. And it is a theme that comes up from time to time, although not that much. And I think for people doing this for the first time, including, yours truly thinking about this, like it's just this reflexive, the more equity I can retain, the better. And I think that is something that you get beyond. It's maybe a little bit naive. And you can also kind of distill it to be to this framework, which you hear people use in a lot of different contexts. Do I want to own 95% or 100% of a smaller pie, or 80% of a bigger pie, or 70% of a bigger pie? And 70 and 8, and this is also actually can get into self-funded versus traditional. But when you do that, when you're looking at that, you're comparing, owning 80 and 90% of a business versus just 25. So there's a big delta in your ownership. So that, let's put that aside. In your case, or in a self-funded searcher's case, we're just talking about 100 versus 90 versus 80 versus 70. You're still going to we're still talking about you, the searcher, ending up with a really big piece of the business, 70%, maybe 80%. So it still means it's not going to have any impact on your control. You are going to have investors. So you are going to be responsible for people's capital. So there is that element, and that's important, and that needs to be taken seriously. But even in your case, you do have an investor in your father. And so you do have somebody whose capital you're responsible for. But yeah, again, just to kind of distill, 95 or 100% ownership, is it worth that versus maybe 80, 70% ownership, but having an ultimately, more oxygen, more ways to go after that low hanging fruit, and ultimately maybe a bigger exit. That's kind of the way to think about it. And I'm not saying that it's wrong to do what you did, but you're feeling that you're in it and you're feeling that kind of tension between those two choices.
Yeah. And I think it's also, you look at, there's kind of this, the model is always you buy a business and as long as you maintain it, your outcome is still pretty awesome.
Yeah.
You pay off the debt and then, hopefully you grow. Even if you just grow with inflation, you have a pretty awesome outcome after, 5, 7, 10 years.
Yeah.
But the other side of it is you're buying a business that you're transitioning from one mindset, which is not short term, but maximize profitability for an aging owner. And you're putting it into a mindset of maximize growth, for future potential. And that takes spending money. And I think that was one of the things that I didn't realize was it would be nice to have a little bit more, spending room. Although I don't know if I would have done anything differently, right? Because I didn't know enough to go out there and be like, oh, I'm going to invest in these 3 strategic areas and build out this team and do whatever. I just kind of grabbed stuff as I went. But I do think that's just, advice for other searchers is if you're looking at something and you're saying, hey, I'm going to change this business, I'm going to improve it, I'm going to grow it aggressively, that's probably going to take money. And, money doesn't pay off now, right? Like you spend money now, you don't get the money back tomorrow. You get it back in a year, in 2 years, 3 years. So anyway, that's just a lesson that I wanted to share.
A great lesson. Thank you. Let's hear about your transition. So you said you've been in it now a year and a half. So how did the first 6 and 12 months look?
Yep. And I will say I deliberately waited to do anything like this because I just didn't want to be the guy who was like 6 months in and naive and being like, oh, everything's so awesome. And, I didn't want to jinx myself. So I feel like I'm definitely, I'm through the honeymoon phase now and I'm, I've got a couple notches on my belt and I've got, some feelings of confidence now that I will survive.
And of being humbled.
Yeah. Being humbled, but also being, now I kind of know what I'm doing. So, transition, the announcement day was hilarious or very, scary as the buyer. So we closed, on whatever, June 8th, 7th. And then the 8th, the next day was announcement day. So it's a construction component of the business. Everybody starts work at like 7 a.m. at the latest. And so everyone shows up to the office. All the employees show up to the office. All these guys go straight out to the job site. So none of these people come into the office on a regular basis. It's like a very rare occurrence. So everybody's going, what's going on? Everybody's coming into the office at 6:30. And so I'm on the highway at like 5 a.m. And I go on an off ramp from one highway to the other and just come to a grinding halt. And there was some horrendous accident on the highway. And I got stuck. Couldn't move an inch for like 4 hours.
Whoa.
And so the 30-something employees are in the shop for the first time in forever.
Oh, no.
And the seller's calling me and going, hey, so... And I was like, hold on. It's got to clear up soon. I'm coming. Just keep them there. And then after 3 hours or whatever, he's like, listen, everybody's kind of wondering. I don't know if I made him stay there for 3 hours, but I was like, no, I got to get there. I want to be there. I got to meet everybody. And so he had to do the announcement without me there. So everyone's sitting there and he's like, I sold to this guy. He's really great. You guys are going to love him. He's not here. So
he's stuck in traffic. You guys all made it. But man, that must have been what you must have just been slamming your steering wheel. I mean, that would have been such an incredibly anxiety inducing moment.
Yeah, it was. Yeah, that was a stressful moment, but got to meet everybody over the first few days or whatever. And, I don't think in hindsight that it had as big of an impact as I felt like it was in that moment, right? In that moment, you're like, oh my God, this is the end. Yeah. Day one, it's over.
Yeah. I screwed up my very first 5 minutes. How did this happen?
So that was announcement day. Transition from there was, it was challenging. So I came in, there were two sellers, both master plumbers, both worked a ton of hours. Like each of these guys worked 100 hours a week. Like actually, it was insane. And both master plumbers, both very good at their jobs. And I knew I had to come in and replace guys that I couldn't replace like for like. Like I couldn't come in and be the plumbing expert on day one. Now we had enough staff and we had a little bit of a management layer, like half of a management layer, I would call it. And we had expert plumbers other than the sellers, but I knew that I couldn't come in and fill the job, right? So I had to hire to replace the one seller. And obviously you're hiring somebody who doesn't own the business. So you're not going to get as good of a person. And then I had to take over, the seller's responsibility. He was basically, running the show, and then the other seller was in the field. So I hired the field guy, and then I replaced Joe. So I came in and kind of immediately realized that I'm not going to be able to replace all this stuff. I got to be able to delegate some of this. One, the plumbing expertise, I'm not going to be able to catch up. I'm not going to be able to learn that in 6 months. And two, the guy just, both of these guys worked 100 hours a week. Like actually, they were on call every weekend, 24/7 emergency service. Like it was their cell phones. And so I think I knew that before closing, but I don't think I understood what it meant. So it was kind of like one of those, I knew they worked a lot. I knew there was this emergency service stuff, but I just didn't understand like how much they worked. And for me coming in, my commute is about 50 minutes each way. So basically like there's 2 hours in the car per day. So there's 10 hours a week that they didn't have to worry about. And then I've got young kids and my wife works. So like I got to be home. So it was a very quick realization that I wasn't going to be able to come in and just take over his exact job. So I had to very quickly kind of reorganize. I had to hire a couple people. I had to delegate some stuff. So thankfully I had a great relationship with the sellers. They're extremely helpful. They worked their asses off through the transition. I could have seen a very different outcome, which I've heard plenty of people talk about on your show, where the sellers, get their check and kind of coast. These guys did not do it. They did everything they could to ensure I was successful. So that was huge. But yeah, had to make some changes quickly.
But just Peter, so basically the answer was you had to hire quickly and more than you thought. I mean, 100 hours a week from each of these two people, that's 200 man hours to fill, to replace. And they're high quality man hours because they're owners and they're expert plumbers. So it's really not hour for hour. It's probably whatever. It's probably it's 200 hours divided by 40 is 5 people, but maybe you really need 6 people to replace what these guys are doing. Is that arithmetic working out? So these two gentlemen need to be replaced by about 6 people, plus 5 others, something like that.
Never thought about it that clearly, but yeah, it's pretty much. No, so I think I budgeted for hiring one person. I had to hire 2 just to kind of scrape by. And then I spent quite a bit of time. I've since hired, several more people that are true kind of like office, level people. But yeah, I definitely, I had to hire a person that I wasn't planning on, and I had to delegate a bunch of stuff to the team. So I had a couple people that really needed to level up. And so it went pretty good. I had a ton of support from the sellers. And I was able to, have a lifestyle that wasn't going to get me, divorced and miserable, so I was able to make it into, I still work, a lot, but, maybe I work 60 hours a week or 55. I'm including my commute in that, right? So it's really maybe a little bit less than that, but,
and
so
even with this
I was
really
able to transition to a point where I was okay and the business was okay. But it was just, it was that those are kind of the stories that you hear. And I think if I didn't have the support of the sellers, I would have been in a really tough spot.
And so you really, it was hard, but this was not a fetal transition. There were no fetal position moments.
No, the business was handed off in really good shape. The diligence that I was able to do on the construction business was limited based on, their data. And so I took a big leap of faith in him telling me that there was a healthy backlog. And there was, thankfully. So the business was handed off in good shape. The sellers were super helpful. The transition worked fine. There were no fetal position moments. There were plenty of moments of fear. But I never got close to financial issues. I never had to worry about making payroll.
Let me ask on that, because we when we were talking about how much equity you retained and the size of the loan. So even with you kind of maxing out what you could in terms of retaining ownership, which meant big loan payments, even with that, and with the discovery that you were going to have to hire more than you thought to replace the two owners. So that's the J curve that we have already talked about. You still felt like you had room, like you never worried about missing payroll or whatever.
Yeah, I had room. The deal, even with, talking about the leverage, the deal had plenty of wiggle room. I had working capital was included in the deal. And I had a line of credit, that was kind of the emergency fund. So yeah, financially, I knew that profit was dipping in the J curve, but I didn't ever get close to the trees, or at least that close to the trees. But I will say there's been a couple times, right now everything's pretty cool, but like there was a point where I was like a year in, and I looked at the bank account and I was like, man, I have worked really hard. And that's the number that's in the bank account after a year. So, that's, when you and I spoke, I think I said, so somebody asked me, I was about a year in, and they go, oh man, how's it going? And I was like, yeah, you always have kind of a range of how you think things are going to go. And I go, yeah, things have gone like 7 out of 10 good. And then I paused for a second. I was like, what the hell am I talking about? Like, there's been so many like crazy external challenges or internal challenges, whatever, just like so much hard stuff and so many things that have not gone my way. Plenty of stuff went well. So like, but I kind of revised that and I was like, things have gone 5 out of 10 good. And, a couple of things that we just talked about, the seller hours, but offset by incredible support from the sellers. And, having to make transitions of who's responsible for what very early days, where I wasn't able to, execute the same level as the seller, having to have other people pick up that stuff, you kind of lose some quality there, right? You're transitioning stuff from a seller to an employee. You're always going to have a little less performance. So, some of that stuff. But I think one of the big things that, the big negative that I experienced was turnover. And I'll share a little piece of that I didn't grasp. and as a good piece of diligence, hopefully for somebody, is so I had 2 sellers to transition. So that in itself, high level of turnover if you're managing that type of transition. What I didn't realize, kind of right around when the deal went to market, they had turnover in 2 of the office staff. Now there's like 12 office staff, or there were 10 when I bought it, or 9 or something. So they had transitioned 2 of the office staff they had turned over. And by the time I closed, the 2 new people had been there for 6 months. But I didn't realize until quite a ways in that the 2 people who left, it was like a bookkeeper and a billing person, those 2 people were just like a rock star team, and they were running this show. They had been there for, one was there for 6 years, one was there for 10, and the sellers replaced them with people who could fill the seat until they sold the business. Not that they made like a, disastrous hire, but I had 2 people who were fairly new, and I didn't realize they're both, not here anymore. One of them we fired and one of them left on their own, but they were just like, they had 2 A players before, and those 2 A players got replaced with like C players. And I had no idea. You come into this business, you can only rely on the people around and kind of say, hey, was this how stuff was going before? Because all you're trying to do is keep things running the same as before.
Yeah.
But so what I realized down the line was, I had to transition the 2 sellers, and I had to transition these 2 other people that I didn't even realize counted as turnover because it happened 6 months before I got there. But really, I lost 2 really important team members before I ever got there.
Yeah.
So that was, there's 4 people out of office staff of, call it 10. Then I'll give a little example of a mistake I made. Right after closing, I knew I had to replace the field guy. So it was like day 1, we were like, all right, guys, let's draft this job description. We got to get somebody in here. And so put together a job description with the help of the sellers and the other people there. And we posted on Indeed, and Indeed like pushes you to put a salary range. And I talked with them. I was like, I don't know. And they were like, no, you should put a salary range. It's really high. It's really hard to find people of a certain caliber. And you need to put a salary range that shows that you're serious, right? Plumbers are hard to hire, and hiring like, salaried supervisor level plumbers is even harder. And so they said, put a salary range on it. Put a salary range on it, not realizing that the job description was pretty similar to somebody else who worked there. And
oh no,
that our lead foreman, who was like kind of our top hourly plumber, he had been promised over the last 4 years that he was going to get this job. I didn't know that. And so I put up this job posting with this huge salary on it. And so everybody saw it. And the lead foreman quit on a 1-day notice because he was so pissed at the seller who promised him this job. I had no idea. And then the other supervisor, the guy who wasn't the seller, he quit after a year. And, it was just like one of those things that, what was I going to do? Like argue with the seller and be like, no, I shouldn't put a salary range on it. He said, listen, like it's hard to find plumbers. You got to put a salary range so you attract good candidates. But little did I know, there was all this backstory. And by putting the salary range, I was going to piss off 2 other important employees. So, they probably would have left anyway. But just like the little things that you don't know what mistakes you're making while you're in it. And so, there's another couple employees that turned over in the first year. And so that just really makes things hard the less stability you have, because you lose every person that walks out the door. You lose tribal knowledge.
Exactly.
You lose the history. You lose the knowledge of the jobs that we're working on, the customers. So,
and when the whole argument for search, or for like the types of a services business where your asset is the people, it's not CapEx, it's not whatever. It's the people. When people with tribal institutional knowledge walk out the door, it's effectively, you're losing some enterprise value. It's not, because you can't just replace them like for like, because they had a lot of the value of the business that you bought was locked up in their heads.
Mm-hmm. Yep. So that was a big challenge.
Peter, let's try to codify a couple of the learnings there. I think. Tell me if you agree with this. So on the one thing where the two office staff that you inherited but didn't realize that they were C players and that this pair of A players had left 6 months prior. Maybe the learning for the listener is, in your diligence, ask a seller, have there been who's exited the business in the last year?
Yeah, well,
and really
I knew
try
that.
to.
It was
you
that
knew
was a
about them.
conversation in diligence. I wouldn't have comprehended that
How valuable
the
they were.
bookkeeper and the billing person who had worked together for 10 years had this like rock star show, and they had all this stuff that they did together, and the two people who came in after, to be fair, they probably didn't get the same attention and training that they deserved because everybody knew that they were exiting. The sellers knew that they were exiting.
Yeah.
But they just, and they were hired in a hurry, I think.
Yeah.
And they just weren't as good as the team that left. And I didn't know who the team that left was. I just thought you replaced your bookkeeper with another bookkeeper.
Yeah.
I just didn't realize that, the 10-year bookkeeper was really awesome.
Yeah. Okay. Well, and then on the other one where you put the salary and the foreman who's been promised this role quits the next day. And I think this is probably more commonly known, is the learning there that you ask the seller, hey, have any promises been made? I mean, I know this is something that people talk about doing, diligencing. Do you think that, did you do anything like that? Do you think it would have uncovered this problem? Hey, seller, hey, Joe, has any of the employee, any of the staff been promised anything that I might run afoul of if I'm unaware?
I knew that he was grooming this guy for this type of role.
Okay.
I didn't realize that in this guy's eyes, he was being promised for years that this was coming. So whether or not I put the salary range, when he saw that job posting and it wasn't him, that would have done it.
Peter, one of the things that you said to me in our pre-call was that these problems, you were actually sort of at home fixing these problems. I think these problems, maybe you were referring to other problems. Do you recall that? And what did you mean?
I don't know what I meant. I think what I meant was, there were all these challenges along the way. I also, by the way, there was an employee who left maybe like a year before I got there, and the sellers didn't know, but he started another plumbing company. And over the course of my first year in business, he slowly but surely called on all of our biggest customers and started pulling them away. But it was, again, it's like something that happened a year before I got there. How would you, they wouldn't have even known to answer that question in diligence. But I think what I meant was there's challenges with this. I had the background of 7 years running a business.
The delivery dudes, to be clear.
Yep. And so like I'm familiar with people issues. I'm familiar with the constant challenges that there, in a given day, there's 100 issues and you can only fix 60 of them. So none of this stuff was putting me in the fetal position, I think was maybe what I meant. Yeah. And it's kind of, you gotta have the attitude of taking the good with the bad, and plenty of good stuff has happened along the way too. Like I said, I never had financial issues. The business is growing, we're doing well, but you get punched in the face a lot. That's for sure. Yeah.
And you already had some scar tissue, some muscle built up there to just roll with those punches.
Yep. But it's different. It's different when you got your personal guarantee on the line and you're the owner rather than the employee.
Yeah, of course. Well, and I wonder if there's any part of your skill set that listeners might not have that they can somehow learn from, or maybe there isn't, and it's just you were, at least with respect to your story, in the good position, in the happy position that you just had 7 years of relevant experience, kind of operational people management experience. Just trying to figure out where the listener can benefit from the fact that you were able to take this in stride better than somebody who's totally new to, management?
I think it helps in many ways. It also probably hurts in some ways. I came in and I was like, I know what this org chart is going to look like in 3 years. Like, I know how this business is going to grow. I've been through this before. I've taken a company from, one layer of management to two.
Yeah.
And I came in and kind of said, I know the direction we're heading. I'm going to start marching in that direction. Whereas in hindsight, maybe the better move would have been, I'm going to keep my head down and learn to be the seller. Even if I don't feel like I'm the plumbing expert, I should spend the next 6 months or year learning to do exactly what he did and focus on the day to day. And don't be so strategic, and don't think that, you want to march on a 3-year plan.
Really interesting. A couple other things from our pre-call, Peter, that I think the audience can benefit from. First of all, well, actually one connects to what you just said about kind of, rather than coming in as Mr. Strategy, kind of trying to be more like the seller and be more, and learn the trade to the extent that you can really learn the business. You had said to me that the technical piece of these businesses is underappreciated. What did you mean? Like, how has it been being in a business that really is so technical, particularly, as I understand it, commercial plumbing versus residential?
Yeah, I think if you're buying like a residential HVAC shop, I don't know about HVAC. If you're buying a residential plumbing shop, I think you can learn it pretty quickly. The service side of the business is fairly straightforward, learnable in a shorter amount of time. We do a variety of work, and I think a lot of companies do, but I think the thing that's underappreciated is, the technical component. Searchers buy plumbing and HVAC shops all the time. The technical component that is most likely worn by the seller is stuff that you can't learn in 6 months. There's examples, there's customer problems that only surface every 5 years, and the seller being able to answer a question and you not being able to answer a question can be a big deal. And so that, I think, is one of the things that, the popularity of these industries among searchers is huge. I didn't realize it. I thought it was learnable and hireable. And it is. Like, things are good, and I've got a whole lot of answers. I probably know more about like technical weird plumbing, troubleshooting than I do about like, how to change the flapper on a toilet. But there's definitely, there's an element of the technical side that, you got to be conscious of. You're replacing a seller who's got 40 years of plumbing experience with some, 30-something-year-old kid who doesn't know shit. And that's a big gap in the eyes of your customers.
And so what's the answer there? You're obviously learning as much as you can, as quickly as you can, hiring to fill the gap as much as you can. And is that basically the playbook, and kind of marching forward with a confident face?
Yep. It's all three. It's learning yourself, it's hiring people to support you, and it's having a good relationship with the seller.
Yeah.
And I still make that call, when we've got tricky stuff, they're there.
You mentioned earlier licensing. So how did that play out how did you deal with that? What's it look like?
Let me rewind. I did want to share one thing. This guy on Twitter posted it, but I can't take credit for it, but I just it resonated with me. It came up recently on Twitter. And this kind of ties in the last two things we talked about, the strategy guy and the technical thing. This guy, I forget who it was. I forget what his story was, but I think it was a guy who bought a business and went bankrupt. And he posted his story on Twitter. I wish I remember the guy's name so I could give him credit. But one of the things he said in this mile-long, 100-post thing was, I thought that the employees wanted a clear vision, thought that they wanted leadership and an opportunity to grow in their career. And what they really wanted was direct instruction from an expert in the business. And that hit home for me so much. And this guy obviously landed in a different outcome than I did. I've never heard anyone say it like that, but that I think was the absolute biggest lesson. I came from an environment of accountability, of people with a growth mindset and hungry people who hold themselves accountable and want to achieve. And you come into these, this business that's in a so-called sleepy industry, and you kind of go, yeah, I'm going to be this great leader and we're all going to march forward together. And what you don't realize is, yes, that's a great outcome, but it takes a long time to create that culture shift. And when you come in on day one and try to replace the seller who's providing direct instruction with his decades of industry expertise, and you try to replace it with strategy guy, that's a big shift. And it's something that I had to kind of dial back. And that dude's Twitter post really popped out. I'm sure I butchered it in my paraphrasing, but I think that was one of the big things on those two topics that kind of summarized my learnings.
That's great. Great call out.
What was your question?
Yeah, just a more in the weeds question. How did you deal with the license requirements of being the owner of a plumbing business and not having a license yourself?
So there were employees who also had their license. I transitioned to, it was actually the owner's son who's still an employee. The SBA requirement is, and I think it changed recently, but the SBA requirement when I was around was that the seller can work at the business and qualify the business for up to a year, and they can't qualify it after that. And my lender was like obsessed with the licensing issue, and reasonably so. But I had 4 master plumbers in the business that I could access. 2 were employees, 2 were the sellers. And I transitioned the license on closing, and I had employment contracts, with incentives to stick around. So I had plenty of structure in it, but the lender was all over it. Wanted proof of licenses for all the people who weren't, the qualifier even. And anyway, so that was how I did it. I've heard of other people doing it with a, third-party qualifier. There are like retirees who will qualify, 3 businesses and hang their license and earn a little side income, depending on your state. There's different rules around it. Like Florida will let you qualify a few businesses as a license holder, but not like 20. And I think you actually have to go to Tallahassee and like sit in front of the board of professional regulation. If you're a guy who's qualifying multiple businesses, you have to go explain in person why. So anyway, there are like third-party people who will qualify businesses. I think that's common in several states. And I think you can get away with having the seller qualify it as long as you have what the bank considers a credible plan to transition it to someone else. Now, once you close, what I've heard people say, and I don't really know if it's the truth, but like you can have the seller qualify the business for up to a year. And then once you close, like the bank's not going to default you if the seller keeps qualifying your business. So I've heard people say that, like, yeah, you can, in a practical sense, as long as you convince the bank that you're going to switch it to someone else, in a practical sense, you can just have the seller keep qualifying the business. I don't know if that's, how true that is, but I've heard other people say that. My experience was just that I had another guy with the license and I transitioned to him.
You had some working capital learnings. Remember what those were from our pre-call?
Yeah. And I think in the grand scheme of things, like spreadsheet pre-closing, Peter probably would have thought these were a big deal. And post-closing, it's like, yeah, it's a factor, but like, is it that's going to be like affect your odds of success by like a tiny little thing compared to everything else. But I had working capital included in the deal. The construction industry, I've talked with several searchers who are looking at businesses that are in the industry or have a construction component. The construction industry has funky working capital requirements. You have one, you might get deposits, which are hard to analyze because a lot of times sellers just count it as revenue rather than counting it as a liability. Two, you have progress billings. So in our case, we do these big houses. They might take 2-3 years to finish. And so you're billing your customer who's a GC, and you're billing them and saying, hey, I'm 40% complete with this job. So if you bill them 50%, like, are they going to fight you on it? Probably not, because they're getting paid more too as the GC. So they're motivated to be overbilled. So there's an opportunity for overbilling. And then three, there's a thing called retainage, which adds even more complexity to it, but we don't need to get into the detailed stuff. But the progress billings is really the piece where buyer beware. My deal, like, definitely I closed and we were overbilled, and I didn't really know until down the line that basically, like, you know, there wasn't a lot of meat on the bone on some of these projects. Not that it was like gross, you know, it wasn't anything like fraudulent or bad. It was just like, you know, natural behavior. And I had some protection, loose language in the APA that protected me, you know, if anything bad happened. But basically, like, as a buyer, how in the world are you going to go look at a house that's like halfway built with pipes sticking out of the ground and know if it's 40 or 50%?
Yeah, totally.
Like, you have no clue. So you're at the mercy of the seller. You know, I didn't even figure out which ones were overbilled and underbilled until 6 months in. I was just looking at, you know, the revenue in the first 2 months, and I was like, man, like, why aren't we doing much in sales? And it was because we had a couple projects that were billed ahead of where they actually were. So anyway, that was like a little blip in the radar. It wasn't a big thing, but definitely opportunity for it to be a bigger thing for somebody else. So be aware of construction and your lack of knowledge as a buyer.
Great. Well, let's start wrapping up here, Peter. This has been just fantastic. What is your plan here?
So my plan in the financial model pre-buying the business was, the good case was basically double the business in 5 years and sell it. I still am kind of treating that as plan A. I very well may not sell it. But going through my experience at Delivery Dudes of not being able to sell when you wanted to, was a very real lesson. And in my eyes, you kind of have to set the business up for exit in order to have the option. Like, yeah. I'd hate to get down the line and not have the business be, you know, I'm sure it'll be sellable at anyway, but, you know, not have it be maximized. And then you only have one plan, and that plan is to hang on. So I'm kind of treating that as plan A, even though it will, you know, very likely could become plan B. Despite all the things that I've talked about, the challenges, like, it is fun. It is gratifying. It is a very cool thing to do. And if I find a way to dial back my hours a little bit, then by all means, like, I'll hang on to this thing. It's a fun challenge. It's cool. It's something different than you get in other jobs, and maybe it's plumbing specific, but like, every single day you have people that have problems in their life, and every single day you are solving problems and you are creating things that have physical, like, good and value to the world. And that, I think, is something that I didn't really see as tangible in anything else I did. Like, sure, at Delivery Dudes, we were like delivering people food, and cool. But there is something nice about every day you are solving people's problems for them.
Yeah.
You are creating good in the world and something that is visible and lasting and all that stuff. So I love that element of it. It's a lot of fun. It's a lot of, you say like you learn something new every day. Like I learn 10 new things every day. It's cool. There's always a challenge. Even the guys I've got around that have tons of experience, it's just like, everybody's passionate about it. It's something you can always keep learning at. So I really like the industry, love the business. I'm treating plan A as grow it and be able to sell it. And maybe I will, maybe I won't.
Okay, Peter, anything that we didn't get to? We sure got to a lot, but maybe I overlooked something. Anything you want to tell the audience?
I do think, like as a whole, the opportunity is just, I think it's crazy. So, you know how when you like go get your first big boy job and you get your own place and you just kind of like, oh, I can do whatever I want. Like I can eat ice cream for breakfast. Like I can drink a beer at 10 a.m. Like no one's going to stop me. You can do whatever you want. For me, like I think the search concept is exactly that. It's just like, if you told me that I could just go buy a 35 employee plumbing business with mostly other people's money and like no one's going to stop you from doing that or ask questions like, why the hell are you doing this? And like, you can just do it. Like no one's going to stop you. I just think that's like, for me, it was like that exact moment. I think it's just, I'm really passionate about the search space. And I just think it's such a crazy thing. Like you can just go do that. No one's going to stop you. And so I don't know. I love, I'm really happy to, have done the podcast with you. I just think it's such a cool space. I think it's such a cool thing that we're seeing. I think it's really like, it's going to define the next generation of businesses, the way that this concept is growing. And I just still like, some days I wake up and like, how in the world is this a possibility? Like, I don't know, maybe I need to like fly the American flag more, but it's just cool. You can do whatever you want.
No, that is so well put, Peter. I might actually clip that and put it on social media, something I never do. That's probably, I feel like I've tried to articulate that once or twice, where part of my falling in love with this whole concept of buying a business was that it, all of a sudden, it just expands the possibilities so much more. And I was somebody who came from kind of more 0 to 1 entrepreneurship. And for some reason, this path of entrepreneurship makes me feel a sense of possibility more than starting from scratch entrepreneurship, which is maybe a bit counterintuitive because you'd think that a blank canvas means more opportunity. But anyway, so I loved how you put that. Great note to end on.
Yeah. Well, and then to bring it back to maybe the more selfish financial world of that, like my joke or half joke with my buddy Morgan, who was on your earlier podcast, is 8 figs or bust, because that's the next level of doing whatever the hell you want, right? Like you can do whatever you want and buy a business, but you buy a business and have an 8-figure exit, then you can really do whatever you want. You don't even have to work. So that's kind of been the joke. And I think that's for all of the philosophical stuff about Search Fund, like the financial outcome is a real possibility. And, who knows if I'll hit that. Maybe maybe I'll hang on to the business for 20 years and I'll hit it, or maybe I'll get lucky or something, but it's cool. And I think that's, there's so many of those outcomes in the space, and, hopefully I, land somewhere, maybe not in that world, but, land somewhere nice along the way, with the growth plan. So I think that should be the mantra of all the searchers.
How do we feel about 8 figs or bust being the title of this episode? By the way, I love that.
Well, that's like every phone call. I'll be talking to him on the drive home all the time. He'll be like, "Oh, I'm thinking about making this big move. I'm going to hire these 2 people. It's going to drop my EBITDA back down to like below where it was at closing, but it's going to be this great investment." And I'll call him with the same stuff, right? And every time we're like thinking about making some like, sort of risky investment in the business, it's always like, well, 8 figs or bust. And it's so childish, and it is half a joke. Like that's what's driving us, but it's funny.
Yeah, it is. It's great. And so I may well be using that in the title. That's just great.
Great. We'll let everybody think I'm an asshole.
Cool. Well, how can people get in touch with you here, Peter? How do you prefer?
Oh gosh, I don't know. I'm a lurker
LinkedIn?
on Twitter. I don't think I've ever posted, but you could probably find me there. I'm on Search Funder, and you can, I don't know, whatever, everywhere. LinkedIn, Facebook, Instagram. I'm around.
All right. We'll do LinkedIn if nothing else. Peter deBaptiste, thank you very much for doing this. This has been a great interview.
Thanks, Will. It's been fun.
I hope you enjoyed that interview. Make sure you subscribe to the Acquiring Minds channel below. We are now publishing twice a week, so tons of new interviews and stories to come. Stories that will help you along your own path to acquiring a business.